Leo Tolstoy, in the opening of Anna Karenina, writes that all happy families are alike, while every unhappy family is unhappy in its own way. This is especially true in the economic field when it comes to economic and financial crises. Every crisis is different from the others. We have, in the world, two major examples of significant crises. The one in 2001, the so-called dot-com bubble, and the one in 2008, the so-called subprime bubble. They seem similar when you look at them in a textbook through a chart showing the stock market trend, yet they have extremely different causes and consequences. If we look at the stock index of the United States of America, the Standard & Poor's 500, we see that the two major crises mentioned earlier, the one in 2001 and the one in 2008, look like the humps of a camel. They are actually very similar to each other, but they have some very important intrinsic differences. Before we look at these crises in detail, let's take a look at the main events that have shaped the historical trend of the Standard & Poor's 500. What are the main events that have characterized it? We can see them in this chart. From 1995 to 2000, there's a very strong growth in the stock market, like never before, and that's because something different is happening again. A technological frontier is being broken. We'll see this more clearly in a moment. From 2000 to 2001, there's a sharp drop in stock market prices. In 2001, the growth comes to a complete halt and the bubble that we'll call the dot-com bubble bursts. In 2008, something similar happens on the stock market. There's a strong rise in share prices, but this time it's driven by a different factor, no longer the technological frontier. In 2008, there will be the great financial crisis. And then in 2020 and 2022, we'll have the pandemic crisis and the international war crisis due to the Russian invasion of Ukraine. Looking more closely at the 2001 crisis, we can see something particularly interesting by comparing two stock market indices, the Standard & Poor's 500, which we've already discussed, and another index, the Nasdaq 100, which includes the value of 100 major companies listed on the United States market, the most highly capitalized ones, those with the biggest profits and returns on the market. In the year between 2000 and 2001, when this bubble was building up, the Nasdaq 100 performed much more strongly on the financial market than the Standard & Poor's 500. And this happened because the most important companies on the American market were those connected to the Internet, which was the new technology. A bit like the railways were at the end of the 1800s. Everyone who imagines a heroic future for companies involved in information technology starts investing in IT. And everything that ends up on the stock market with the dot-com label is considered a gold mine. It doesn't matter to look at the accounts inside each company. What matters is that they end with .com. This big craze keeps going, creating a speculative bubble. So the prices of these stocks keep rising, but there isn't actually any real underlying economic value that's truly growing. In the end, no one really looks at it closely. When people realize that not everything that glitters is gold, or that not everything called .com is good, that's when the selling starts, and these sell-offs lead to an almost instant collapse in prices. It's a typical feature of bubbles. They build up over many years and then burst in no time at all. We can see it on the chart, where both the Nasdaq and the Standard & Poor's 500 experience a sharp slowdown. In fact, there's a huge decline that brings these indices back to pre-crisis levels, causing a major disruption for the economy. Those who had invested in these modern, cutting-edge ventures often suffer very heavy losses. But the worst losses are yet to come on the New York Stock Exchange. Around 2007 to 2008, there will be a second wave of price drops, and this time it won't be a tech bubble, it's going to be a different kind of bubble. We can see that for the dot-com bubble burst, the Standard & Poor's 500 index rises again. It rises at a pace very similar to what it had before the dot-com crisis hit. And that's because a new wave of speculation is triggered. Investors found something new to put their money into, and in particular, they discovered that real estate prices tend to go up a lot. So people start investing in houses, obviously taking out mortgages from banks, which are more than happy to grant these loans. And sometimes they even lend out more than 100% of the value of the house, because they see that on the financial markets, the value of these properties is constantly rising. So they're absolutely certain they'll get back what they've lent without any problem. But the problem, in reality, happens and not long after. We can see this in the next chart, where we once again compare the Standard & Poor's 500 index and a real estate index. This time, it shows the trend of housing prices in the United States of America in 2007. Or we can even go back to 2006, 2 years before the outbreak of the Great Crisis of 2008, when house prices started to fall. Why is that? Because in the meantime, the central bank, seeing that the economy is recovering, that the slope after the dot-com crisis is picking up again. Little by little, interest rates are going up. Many people who bought homes for real estate speculation with variable rates now have to pay much higher variable payments. And many investors in the real estate market are no longer able to pay these payments, so they end up defaulting in the real estate market. They're no longer able to pay their installments. The banks are convinced they'll be able to sell the houses to recover what they lent. And when the banks start selling houses en masse, house prices collapse. This is already happening in 2006. You can see it in the red line. In 2007, it got even worse, and in 2008, house prices hit their lowest levels in 3 years. This time, the real estate market led the trend in the financial market, and the Standard & Poor 500 collapsed completely in 2008, with the fall of that major financial powerhouse, Lehman Brothers Investment Bank, which went bankrupt on September 15, 2008. But that's just the final act of a crisis that had actually been building for 2 years, as we can see in the real estate market. So these two major crises were driven by two different factors: speculation on new technology for the dot-com bubble and speculation in the real estate market for the subprime bubble. It's called subprime because the clients who borrowed money to buy houses weren't all top-tier clients. Some of them were actually not very reliable, therefore subprime. Nevertheless, the banks gave credit to anyone because they believed that house prices would always go up. We can see it in the graph, can't we? At a certain point, prices start to fall, and that's when the entire financial bubble bursts. To retrieve the financial and real estate data that have guided us through this long story of the 2001 and 2008 crises, now let's head to the lab. And here we are in the lab. To search online for the two historical series of the Standard & Poor's 500 and the NASDAQ, we retrieve them from the Yahoo Finance website. Yahoo Finance, Stock Market Live, quotes, "Let's go in." And here we can get the labels for the historical series. If we search for S&P 500, we see that the index has the label *GSPC, so let's remember this label. If we search for the NASDAQ 100, we see that the index has the label *NDX. Armed with this information, let's go to the software. I open Lesson 3, which I had already prepared. And we see that it's used to load data directly from Yahoo. Once installed the QuantMod package, we use library QuantMod, and we can use the getSymbols command, which pulls the data directly from Yahoo. The data are the GSPC and NDX, which we've already seen. We need to specify that the source, SRC, is Yahoo. We want the return class, the output of this command, to be a ZooTime series, which is very flexible and suitable for our manipulations. We'll take the data starting from January 1st, 1985. Note that in R, dates are written as year, then month, then day. At this point, we get the two-time series, GSPX and NDX. Let's see what's inside View GSPC. It's a data table that contains the opening prices, the highest prices, the lowest prices, the closing prices, the volumes, and the adjusted closing prices. We are particularly interested in the adjusted closing prices. So we want to put the two together using only the adjusted closing prices. To merge two time series, you use the merge command. I'm putting them together in the S matrix. From GSPC, I'm taking only the adjusted closing prices, and from NDX, with the $sign, I'm also taking only the adjusted closing prices. But I don't want all of them to be equal to false. I only want the adjusted closing prices that are available for both on the same dates. So I don't need all the dates from the time series, just the ones when both markets are open. By running this command, I get the time series S. I can plot it, just like we did in the previous lesson, using the plot command. At this point, we can add a label to the x-axis, x label. In this case, I won't put anything. And add a label to the y-axis, y label, where I'll put stock indices. Let's see what comes out. We can add a grid, if we like it, to the background of the chart, and then a legend in the top left indicating which are the two series, red and blue. At this point, we can add the relevant dates and events. We put in the dates by indicating that they are strings of alphanumeric values, but in reality, they should be considered as dates, as if they were the sequence of concatenated dates. Yes, this letter C stands for concatenated. We have March 10, 2000, the burst of the dot-com bubble, September 15, 2008, the collapse of Lehman Brothers, and March 20, 2020, the first pandemic lockdowns. Let's press Ctrl and Enter. The events, that is, the description, are dot-com bubble, where this /n indicates a new line. So after the word bubble, you need to go to a new line and write .com, Lehman Brothers and pandemic. Let's press Ctrl and Enter, and now we need a command that represents straight lines, lines on the graph. The command is abline, which actually draws straight lines. The option is V for vertical, so I want vertical lines at the dates I defined with line type 2. And we have two dashed lines. Control and Enter, and we can see the three dashed lines. Then you need to insert some text. The text needs to be placed at an X and a Y coordinate. The X coordinate for the text is the dates. The Y coordinate for the text is the maximum value of S, meaning I want to put the text at the top of the chart. As labels for these events, I actually want the variable events. Position 1 means below the point indicated by the coordinates, position 2 would be to the left, position 3 above, and position 4 to the right by pressing Enter. This way, I get the description of the events that mainly influence the stock market. We're now at the end of the lesson. See you next time for new and wonderful adventures.